Have you ever thought about the relationship between the United States and Canada? For most of us, it's a comfortable old friendship. We picture the world's longest, friendliest, undefended border, a shared culture, and a seamless flow of goods. It's a partnership so deep that we've taken it completely for granted. But what if I told you that this bedrock of North American stability is quietly and deliberately being dismantled? What if the greatest threat to American jobs isn't coming from overseas, but from our closest neighbor, who is methodically cutting the ties that bind us? This isn't a theory. It's happening right now, and it's about to send a shockwave through the American economy. 7 of our biggest brands are on the front lines, and what's happening to them is a warning sign for all of us. Imagine a frigid winter morning in Ottawa. Inside a stately conference room, trade ministers from 11 nations, global players like Japan, Australia, South Korea, and the United Kingdom, are all smiles, signing historic agreements. Meanwhile, American representatives are left waiting in the hall, uninvited. This isn't just a diplomatic snub, it's a calculated masterstroke. Canada, long America's largest trading partner, is building a powerful new global network designed specifically to bypass the United States. The scale of what's at stake is staggering. Our trade with Canada totals a mind-boggling $780 billion annually, more than with China, Mexico, or the entire European Union. For decades, American companies built their business models on this unbreakable relationship, investing billions and creating hundreds of thousands of jobs. But Canada's new partnerships are a direct assault on that assumption. Each new ally has been chosen to target a sector where American companies have grown complacent. The doors that were once wide open for American business are now being slammed shut, and for 7 flagship American brands, this is becoming an existential crisis. If you find this perspective on our northern border surprising, and you think more people should be aware of what's happening, please take a moment to hit the like button and share this with your friends and family. It's a conversation we desperately need to have. The first tremors are being felt not in some high-tech lab, but in the giant retail stores we visit every week. Picture a massive distribution center just south of the border, a city of conveyor belts and thousands of employees, where trucks line up for miles to carry American goods north. One famous American retail giant built its entire Canadian expansion on this model, pulling in nearly $850 million a year. But Canada's new alliances are flipping the script. Suddenly, top-of-the-line South Korean electronics and trendy Japanese home goods are being shipped directly to Canadian stores, completely cutting out the American middlemen. The competitive advantage this retailer spent decades building is vanishing. Internal memos paint a terrifying picture. Canadian sales are down 23%, and executives are in emergency meetings discussing which distribution centers to close. When a supply chain that supports entire communities is broken, it isn't just revenue that disappears. It's the jobs and the stability of towns that depend on that cross-border commerce. This disruption is also hitting the heart of American industrial might, our auto industry. Detroit's legacy is built into the DNA of a massive auto parts giant whose components are in millions of cars. Their integrated system was the envy of the world. Parts made in Michigan, assembled in Ontario, and then shipped back to the US. But Canada's new deals with auto powerhouses like South Korea and Japan are throwing a wrench in the works. Canadian car manufacturers can now get state-of-the-art brake systems from South Korea at a 15% tariff advantage. The American giant is now watching as its Canadian partners field joint venture offers from new Asian competitors. Industry insiders are whispering about a total realignment of the North American auto industry, one that could isolate American manufacturers from their biggest partner. The crisis is also rolling across the American heartland. One colossal American agricultural corporation controls over 30% of the $2.3 billion in agricultural goods we export to Canada. Their entire infrastructure along the northern border is built on that massive volume. But now, Australia and Brazil have been given preferential access and are aggressively undercutting American farmers. Australian wheat now enters Canada with a 12% price advantage. When Canadian orders dry up, the collapse dominoes backward through rural America. Farmers in North Dakota, Minnesota, and Montana, for whom Canadian sales are a huge part of their income, are watching prices plummet. Small towns whose economies revolve around processing plants are facing closures. One analyst grimly called it a new dust bowl, caused not by a lack of rain but by a diplomatic drought. What are your thoughts on this? Do you live in a community that relies on cross-border trade with Canada? Let us know in the comments below what you're seeing and how this shift is affecting you. And this isn't just happening on our roads and farms. The same story is unfolding across our most critical sectors. In energy, a U.S. corporation built on interdependence with Canada is watching as our neighbor signs deals with Norway and Australia, rerouting the flow of oil and natural gas to keep the value and jobs in Canada. In technology, a Silicon Valley titan that dominated North American data traffic is now being bypassed by new trans-Pacific fiber optic cables, connecting Canada directly with Asia and Europe. They call it the great decoupling of our digital infrastructure. In manufacturing, a major conglomerate is watching its integrated supply chains break as Canadian partners turn to German and Japanese firms. And in finance, a Wall Street giant is being cut out of the loop as Canadian corporations gain direct access to global capital through new partnerships with financial hubs in Switzerland and Singapore. This isn't just about 7 companies losing market share. This is a cascading crisis. Economists call it the multiplier effect. For every dollar lost in direct sales, another $2.40 is sucked out of the broader American economy. Based on these 7 brands alone, we are looking at a potential hit of nearly $27 billion. This is the systemic dismantling of an economic partnership that took over 70 years to build. The human cost is devastating. Border towns from Washington to Maine face an identity crisis as the commerce they rely on dries up. The truck drivers, customs brokers, and logistics experts whose careers were built on this relationship are discovering their skills are becoming obsolete. On the global chessboard, this is a calculated move to challenge American economic dominance. As Canada thrives with its new diversified partnerships, other allies are watching and taking notes. What stops Mexico or our European partners from following suit? If being America's neighbor no longer means being America's permanent economic partner, then the very foundation of our global influence begins to crumble. The timeline of this collapse is happening at a shocking speed. What took 7 decades to build is showing signs of unraveling in just a few short years. The empty factories and anxious workers are part of a new American reality, where proximity no longer guarantees priority. The thread that has bound our 2 nations is fraying, not with a loud snap, but with a quiet, steady unraveling that most of us haven't even noticed yet. The question we all need to start asking is how close we are willing to get to the edge before we realize what lies on the other side. Thank you so much for watching. If you found this information valuable and thought-provoking, please give it a like, subscribe to the channel, and don't forget to ring that notification bell so you don't miss our future deep dives into the issues that matter most. We'll see you in the next one.